Hello, fellow compounders. Many of you have heard of Berkshire Hathaway and how it averaged 20% annual return between 1965 and 2021. However, in the past 10 years, it has only averaged 13.2%. Its CEO, Warren Buffett, is 92 years old, and his sidekick, Charlie Munger, is 99. At some point in time, they will have to retire from Berkshire. Would there ever be another investment like Berkshire Hathaway? Today, I'm going to review two stocks I own in my coffee can portfolio that are similar to Berkshire Hathaway, and I expect one of them to earn me between 15 to 20% per year for the next 5 years or longer. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor, and you are responsible for your own financial decisions. What am I looking for in a Berkshire-like business? First, I'm looking for it to be led by a CEO that is a good capital allocator and investor-friendly. Someone who will keep growing the business, communicate candidly, and do whatever is best for its shareholders. I'd prefer someone that doesn't have a master of the universe attitude, someone down to earth and humble. Also, I'm looking for a CEO that is much younger than Buffett and with a good track record. Number two, I'm looking for a consistent compounder. Berkshire is a compounding machine. Since Buffett became CEO, Berkshire has compounded at an average of 20% per year versus the S&P 500, which compounded at around 10%. However, as I said, over the past 10 years, ending in 2022, Berkshire has compounded at an average of 13.2%, barely outperforming the S&P 500, which compounded at 12.5%. Most likely, going forward, it will not be able to outperform the S&P 500. Even Buffett said he does not expect the returns of Berkshire to outperform the market by a lot. So we're looking for a business that can outperform Berkshire Hathaway. Three, a business or portfolio of businesses with strong competitive advantages and good growth prospects. We need long runways to continue to compound our money. And four, I'm looking for a decentralized and nimble business. One of the successes of Berkshire Hathaway was to be able to collect a group of good businesses that can work independently. So, based on those criteria, let's look at the two stocks that I own that are similar to Berkshire Hathaway. The first stock that I think of when someone asks me what other stocks look like Berkshire Hathaway is Markel Corporation. Markel is sometimes known as a mini Berkshire. Its main business is property and casualty insurance. The company uses capital generated from the insurance operations to buy non-insurance businesses in diverse areas, both in public and private businesses. Markel is led by Tom Gaynor, a fellow Berkshire shareholder. He is 58 years old, a down-to-earth, very approachable person. I met Tom at Berkshire's annual meeting last year. I also attended the breakfast held in Omaha for Markel shareholders the day after Berkshire's annual meeting. There's a full chapter about him in the book Richer, Wiser, Happier by William Green. If you haven't read it, I highly recommend it. Gaynor was an accountant who audited Markel, and the CEO at the time, Steve Markel, convinced him to join the firm to help him with the investment portfolio. And the first stock that Gaynor recommended buying was, you guessed it, Berkshire Hathaway. He also convinced Steve Markel to model Markel's business after Berkshire Hathaway. Markel has copied Berkshire Hathaway in many ways, and Markel has Berkshire Hathaway embedded in its DNA. So let's see why. The investment philosophy looks very similar to Buffett and Munger's investment tenets. If you recall, Buffett and Munger invest in, number one, businesses they understand, two, with favorable long-term prospects, three, operated by honest and competent people, and four, that can be bought at a very attractive price. Now let's look at what Markel does. Markel invests in, one, businesses with good returns on capital that don't use too much debt. Two, with management teams that possess equal measures of talent and integrity. Three, that can reinvest their earnings at good rates of return or redistribute it. And four, at fair prices. So let's take each of Buffett and Munger's investment criteria. Number one, businesses that you understand. Understanding the business for Buffett really means being able to estimate cash flows that the business can return with a high degree of certainty. For Markel, to determine that a business has a good return on capital without too much debt, it needs to understand the business. So that's point number one. Two, favorable long-term prospects are reflected in Markel's point number three. being able to reinvest their earnings at good rates of return. And 3, operated by capable and honest people is Markel's point number 2, management teams that possess equal measures of talent and integrity. And 4, Berkshire's 4th point has been modified by Markel to be buy at a fair price instead of a very attractive price. Markel's focus is more on finding businesses that can compound for a long time, so they are fine with paying a fair price. In reality, Buffett and Munger have moved towards paying a fair price also. So we can see that both Markel and Berkshire's investment philosophy rhyme. Now, let's look at the structure of the business. Berkshire Hathaway can be segmented into 3 groups of businesses: insurance operations, partially owned businesses which trade in the public market, and fully owned private businesses. Markel has the same structure. They call it the 3 engines. Engine number 1 is insurance, of course, and Markel is a leading global specialty insurance. It insures things like thoroughbred horses, river pontoons, and things that aren't your regular car or home. Their engine number 2 is the investment portfolio of public businesses, similar to Berkshire's portfolio. Its largest positions are Berkshire Hathaway, Brookfield Asset Management, and Alphabet. Engine number 3, Markel Ventures. This is the engine that invests in private businesses. Among other things, it owns Costa Farms, which is the largest cultural grower in North America. It owns Brahmin, which is a handbag manufacturer, and also owns Eagle, which is a residential home building company. So the structure sounds familiar, doesn't it? It's a copy of Berkshire's structure. So how has Markel done with this business? What's their track record? Over the past 20 years, ending in 2022, Markel has had an average annual return of 9.74% versus Berkshire that had a 9.7%. And the SPY ETF also had 9.7%. So Markel beat Berkshire by 0.04%, 4 basis points. Over the past 10 years, Markel has had an average of 11.8% annual return on investment versus Berkshire at 13.2%. Markel has a market cap around $19 billion, which is 36 times smaller than Berkshire's. Markel Ventures, the private investment engine, is in its infancy and has a lot of room to grow. Markel has slightly underperformed Berkshire, but Markel's investment operations are not exactly like Berkshire because it has a large fixed income portfolio, which are the reserves of its insurance operations. As time goes by, it expects the equity portfolio to grow faster and become a larger proportion of the portfolio. With its new private equity engine, Markel Ventures, Markel should be able to increase its return on investments. I think that Markel should be able to compound in the 10 to 12% range over the long term, and it has the potential of outperforming Berkshire because of its smaller size. By the way, last year, Berkshire added shares of Markel to its investment portfolio. If you have a chance to go to Berkshire's annual meeting this year, I highly recommend attending Markel's shareholder breakfast the following day. Tom Gaynor and some of his associates always attend the Berkshire meeting and host a breakfast the day after. I like Markel because it looks like Berkshire Hathaway. And because it's smaller in size, it can find more investment opportunities. It should have a longer growth runway. It also has a younger CEO than Buffett. Currently, it is trading at around $1,375 per share. Morningstar rates Markel a 2-star, with a fair value estimated at $1,250 per share. I own it in my coffee can, and I started my position in 2008. I would be adding more to my coffee can when I can get Markel at a better price. Once in a while, it goes on sale, so I keep it on my watch list. Now to the second stock. The second stock should provide me with an average annual return of 15 to 20%. It's a global company headquartered in North America, and if you had invested $1,000 in it 20 years ago, you would now have close to $30,000. I'll reveal the name and tell you more about it in part 2 of this video.